your comment on FOMC can do better, should do better. What are your thoughts on what it should do better?
So I think we need to have we have our goals that are established for us by Congress. I think we can be doing more to work toward achieving those goals in a more rapid fashion. I think that at this stage, that's really about, if you think about the Fed funds rate, our usual tool, that usual tool, what we'd like to do in this situation is lower it further. There's some room for that. We should be thinking about doing that, given where our variables are. But there's relatively little room. If you think about that, we're targeting the Fed funds rate in a range between 0 and 25 basis points. That's 0.25 percentage point, so that's very low. But what we are doing is we're paying an interest rate on the excess reserves that banks hold with us. That's 0.25 percentage point. We could lower that further. And that sounds like minuscule, but it's really about demonstrating a commitment to staying with the recovery for as long as it takes to get the economy fully recovered. I think that's really what, at times, I think that we have to be careful that we're communicating as effectively and vigorously as possible that we're prepared to do what it takes to stay with the recovery until it is complete. I think, so I think even small actions have a lot of communication content, and that matters because what people are, how monetary policy works is not just about what happens at one meeting. It's people forming expectations about how we're going to be acting at meetings down the road. How fast are we going to be removing accommodation as the economy recovers? Are we going to be removing it rapidly? Or are we going to take it out slowly? Those are the big questions for us. And I think there's things we can do to signal our willingness to stay with the recovery for longer. So the question was about the debt and the deficit. Right now the national debt is around $17 trillion. And I guess the questioner was expressing what kind of concern should we have about that? So that's really outside of my purview as a monetary policymaker. Just like you, I take those decisions as given and I react to them. But let me provide some perspective as an economist about that. The deficit has been declining over the past few years. This is a natural outgrowth of the pictures I showed you about the labor market recovering and the economy recovering. So the deficit declining was something that was predictable 3 or 4 years ago. We knew that was going to happen. Your question about the debt is really, we have a structural problem in the United States. It's not a problem that we have to solve in 2014. It is not a problem we have to solve in 2015. But it is a problem we're going to have to solve down the road, and it's simply a problem of the demographic effect that I described earlier. The aging of the population means that taxes are going to shrink, and the obligations that are owed to people that are in this group that are 65 and older or even older than that is going to grow. That disconnect is going to put upward pressure on the debt. And that's going to be a question that has to be resolved. The level of the debt per se right at this moment is not, I don't think that's what we should be focused on as citizens. But we should be focused on the fact that we have a disconnect between our tax collections and what's owed to our retirees that's going to have to be solved down the road. One point of optimism I will offer on this is that the rate of growth of healthcare costs in the past 2 or 3 years has been much slower than I would have anticipated and most experts would have anticipated. If that slow rate of growth of healthcare costs continues, that is very good news for the magnitude of the gap that I just referred to. But that's a big if.
Okay. Given the fact that the dollar will not be the world currency forever, what do we do as a nation what do we need to do to be prepared for that day?
Yeah, I think about, as a monetary policymaker, I try to think about a lot of contingencies, and that's not a contingency that bulks large on my radar screen. I think of the dollar as a conceivable future that I see playing out as continuing to play the role it does in the world economy.
So what were the factors that led to your no vote in the last FOMC meeting?
So at the last FOMC meeting, So actually we have to go back further. As usual, there's history and context to say. In December of 2012, the Federal Open Market Committee adopted what was called quantitative forward guidance, sometimes called the Evans Rule, in honor of my colleague Charles Evans, the president of the Federal Reserve Bank of Chicago. And what was stated was a very specific form of guidance for what's going to be happening to the path of the federal funds rate. In December of 2012, the committee said that as long as the unemployment rate remained above 6.5%, and the 1 to 2 year ahead outlook for inflation remained below 2.5%, and longer-term inflation expectations remain what anchor, but you can forget about that part. As long as those two conditions were met, the Fed funds rate was going to stay extraordinarily low in this 0 to 25, 0 to a quarter percentage point range. I thought that this was a very helpful piece of communication the committee adopted back in December 2012 because it really provided very specific guidance for people to think about, not just about how the path of the Fed funds rate would look given what they expect for the economy now, but even as shocks hit the economy, you now know, okay, well maybe it's going to take a little longer to get 6.5. You automatically know that interest rates are going to stay lower for longer as well. And that's an automatic stabilizer, automatic form of stimulus that's built into the economy. More generally, I thought it was very helpful for us to provide very clear guidance about the evolution of the Fed funds rate. Now, fast forward to the first part of this year, 2014, and the unemployment rate is 6.7%, getting very close to 6.5. And there was a feeling among the committee, which I shared, that the Evans Rule, this guidance we had offered in December 2012, was becoming obsolete. We were going to have to say something about what was going to happen when the unemployment rate fell below 6.5%. And the committee chose to offer what I would call it, I think has been generally described as being a qualitative form of guidance. Not as specific as the numbers that I just described that have been chosen in December 2012. And I would have preferred to stick with a more quantitative form of guidance. Why did I prefer that quantitative guidance? I think that it provides a more specific notion of how the FOMC is prepared to stay with the recovery even as it advances. It provides guidance in terms of the fact that the economy then knows that interest rates are going to remain low even as conditions improve, and that provides a form of stimulus. I think that the verbal guidance is harder to work with, the qualitative guidance that the FOMC chose to adopt instead. It leaves market participants, financial market participants, guessing about how we're going to react to the evolution of conditions. What will it mean as the unemployment rate falls to 6%? What if it means if it takes a long time to get to 6%? These questions are now left open for market participants to debate and struggle with. That shows up as volatility in market rates, and that's a drag on the recovery. So these are the kinds of concerns that led me to dissent.
Part of your illustrations was the supply-demand tension in labor. How would you reflect applying that same kind of thought or discussion to the issue of business, the economy in business, of supplying a demanded product or a demanded service, which I think is one of our societal challenges right now, is we have legacy services, legacy products that are frankly just plain going to fall off the table, and we're slow to find the new place for the economy to function.
Well, I think that's a very deep and challenging question. But you know, that's the challenge that faces the private sector on an everyday basis, and that's who ends up solving that, not government officials. Is where will the growth come from? Where will our economy go? Our job, I think, is to provide the credit conditions, the background conditions. As monetary policymakers, our job is to provide the background credit conditions to facilitate at an aggregate level that there's enough demand to use the aggregate resources, the total resources available in our society. I think right now, it's true, you don't know where the demand is going to come from. But that's always a question, I think. I think the bigger question is there's uncertainty about the total level of demand that's facing all businesses. And I think that uncertainty is being played out in part because, that's our job, is to try to facilitate more certainty about a higher level of demand for the goods and services that you face, and that's the job of monetary policy. So the question was about the Fed's low interest rate policy is having an adverse impact on savers. I think to try to summarize the question briefly is that. Let me talk about that. So I think savers, and here I mean specifically people who are confronting the problem of rolling over short-term savings. In fact, if you have if you bought a long-term bond, say in 2005 or 2006, the inflation outcomes I've described have actually turned out pretty good for you. Inflation's turned out lower than you would have expected. So if you bought a long-term bond, maybe you have an annuity, these outcomes are actually turned out surprisingly good for you. It's a long-term borrower who's actually been hurt by inflation coming in low. But I think the question is really about someone who's got to roll over investments on a short-term basis and looking for safe, liquid investments as a way to put their money. And that the returns on that are very low. That saver is facing the same forces and problem that we at the Fed are facing. We're both victims of the same circumstances. And what are those circumstances? Those circumstances are that after the events of 2007, and 2008, and 2009, businesses and households don't want to spend. They're all looking for safety. They're all looking for liquidity because they all remember 2007, 2008, suddenly what looked liquid, what looked safe, dried up. And so there's a much bigger demand for safety and security. This is around the world globally. And the supply of what was considered safe and secure, I mean, you go back to 2007, people thought, go back to the first part of the year at least, people thought of anything backed by U.S. residential real estate, any asset, as being a safe asset. Nobody thinks that anymore. People thought of sovereign debt around the world as being a safe asset. Nobody thinks that anymore. So what that means is there's a big increase in demand for safe assets and for safety and security and liquidity, and there's a big, at the same time, there's a restriction of supply. Now, from the Fed's point of view, that means we have to make interest rates really low in order to meet our targets. In fact, we've got interest rates essentially close to zero, and we're still having challenges I've just sketched in meeting our goals. And we're in the same situation as someone who's saving for retirement. The person who's saving for retirement has got to compete with all these people and forces around the world that are now trying to save or looking for the same thing, liquidity and safety. If you're in this business of competing with a large group of people who are looking at the same thing for you, the price you got to pay for that goes up, and the returns you're going to earn are going to go down. So we're all in the same business. We're dealing with the circumstances, the hand that's been dealt with to us by the impact of the Great Recession.
How would Dodd-Frank have prevented the mortgage meltdown, and how will it prevent the next economic meltdown?
So I think there's a number of elements of Dodd-Frank that are very helpful. So let me talk about three in particular that I think are very valuable to Dodd-Frank. Now, with that said, I'm going to say that Dodd-Frank has been helpful. That's all I'm going to say. I think it's moved in the right direction. No, I think we have to be, it's important for us to have the right level of caution and about how useful it's been. But it has definitely moved in the right direction. And let me describe 3 steps it took to move us in the right direction. So step 1 is that large financial institutions, ones that have been identified as systemically important by Dodd-Frank, are required to hold more capital. Now, capital is a big buffer against shocks. That's basically the way that the financial institution has to absorb adverse shocks to its portfolio. And so that's step 1, is we have more protection for the financial system through that higher level of capital. The second piece of Dodd-Frank, which is very valuable, is that during the course of 2008, it was very challenging for the Federal Reserve and other regulators and the government more generally to figure out how to take a systemically important institution, take out what was systemically important out of it, and allow and have that take it over by someone else, run effectively, and let the institution fail at the same time. This was a big challenge throughout this period. I think DoddFrank provides for what's called a living will process, where financial institutions and regulators work together to identify ways to unravel a large, complicated financial institution during a time of insolvency for it. So it becomes, the goal is to make the failure of a large financial institution much more like the failure of a local bank. Local bank fails, that operation is taken over by some other bank or by the FDIC, and the depositors and the community as a whole really does not see much impact from that. It just is a seamless transition from a Friday to a Monday. Now, again, I'm not claiming we're there by any means, but that's I think we're moving again in that direction. The final piece, I think, of DoddFrank that's valuable is the Oversight Council, Financial Stability Oversight Council. The Stability Oversight Council has the ability to be dynamic and thinking about what companies and markets have become systemically important. So we don't have a static definition of always watching the same institutions all the time. So if a company like AIG, in principle, if a company like AIG is exposing itself and the system as a whole to undue amounts of systemic risk, the Oversight Council then can identify it as systemically important and is then becomes subject to extra oversight, possibly extra capital requirements being imposed on it by the Fed. So those are just three pieces. Legislation, as I'm sure that many of you in the room are aware, it's very long. But those are, I think, three pieces of it that are quite helpful in this regard.
A lot of that capital you mentioned in the first point seems to have come from the government in the latest quantitative easing that's been going on. And I'm wondering if you could explain the disconnect that all that capital kind of went to banks and businesses on Main Street haven't really seen the benefits of it.
Yeah, I mean, this is I think it goes back to the forces I described earlier, and it's been a challenge for us at the Fed, and that the challenge is that the desire to spend at the given level of interest rates is low. And that's what we're trying, the goal here is to have enough demand to use up so that businesses feel like, well, you got to hire because we got demand coming around the corner, coming down the road. And when I talk to businesses around, even in the 9th District, which is very healthy compared to the country as a whole, you still hear caution, still hear concerns about we don't see that demand. If you talk to households, you'll also feel that sense of concern. So I think what we're continuing to see is the impact of the fact that we had this big shock in 2008 and 2009, a shock that people were told, a shock in terms of their employment prospects, a shock to businesses in terms of what kinds of funds they could count on. I think that we went through that period of time, and that's been a big retardant on spending, so that even with interest rates as low as they are, we're not able to stimulate the kind of demand out there for goods and services. That demand would translate then into loans, at people coming to banks and asking for loans. And that's the missing connection, is we haven't been able to do enough of that demand stimulus.
How do you reconcile the performance of the stock market in the last 18 months with kind of the lackluster data that you talked about?
Yeah, I'm not I'm not a stock market guy. I'll say that up front. But I'll offer one thought on that, is simply that when interest rates are low, stock market value theory and evidence teaches that stock market valuation should be high. And so I think when you think about how high the stock market is, it should be compared to the level of interest rates you're earning on treasuries. And you shouldn't be just looking at it in isolation at how high it is. So that's all I'll offer on. So it's a very abstract and high-level view of stock markets, but that, I think, is the stock market moves around from day to day, moves around on a 6-month basis. I'm not going to try to explain that to you, but when we're keeping interest rates as low as they are, when we're trying to impress on private markets, interest rates are going to stay low, we should expect that to have some kind of imprint on stock valuations as well. Thank you very much for your questions. Very helpful.